You've probably already been a part of the world's biggest financial market, and you might not have even realized it. I'm talking about the Forex, or foreign exchange market. Now, it can seem super intimidating, but we're going to pull back the curtain on what it is, how it actually works, and why its incredible size really does affect all of us. Let's dive in. I want to start with a number that is just, it's almost impossible to wrap your head around. $4 trillion. So, is that how much is traded in a year, a month? Nope, not even close. That's the amount of money changing hands every single day. To give you some perspective, think about all the stock markets in the entire world: New York, London, Tokyo, all of them. Put them together. The Forex market is about 15 to 20 times bigger than all of that combined. We're talking about a scale that is just on another planet. All right, with a market that huge, we kind of have to understand it, right? So what in the world are people actually trading back and forth in this colossal marketplace? Let's get right into the basics. Now, while that $4 trillion number includes some pretty complex financial wizardry, the heart of the market for most people is something called spot trading. And it's as simple as it sounds. You're trading on the spot for right now. It's just like buying a share of a company at its current price, except here you're buying a currency at its current price for an immediate exchange. So, how does that exchange really work? The best way I've ever heard it described is to think of it like a giant seesaw. One currency's value is always, and I mean always, moving in relation to another's. Let's see how that plays out. See, in Forex, you never after trade a currency all by itself. It's always traded in a pair. So, for example, you trade the euro versus the US dollar. You're essentially betting on which side of that currency seesaw is about to go up and which side is about to go down. This quote really hits the nail on the head. Every time you buy one currency, you are at that exact same moment selling another currency. It's a two-sided transaction every single time. So if you buy the euro in the EUR/USD pair, you are simultaneously selling the US dollar. One goes up in your account as the other goes down. And this dual action is what makes Forex so unique, because it means you can potentially profit in two different directions. Going long is just the jargon for buying a pair, because you're betting the first currency is going to get stronger. Going short is the total opposite. You're selling the pair, betting it's going to get weaker. This is a game changer. You can potentially make money whether a currency is rising or falling. So how do traders measure all these tiny little up and down movements? Well, they use something called a pip. Now, don't worry about the math behind it. Just think of a pip as the smallest little tick that a currency pair's price can move. It's the fundamental unit they use to count up their profits and losses. Okay, so we get that it's huge, and we've got the basics of how a trade works. But who? Who is actually moving this trillions of dollars around the globe every single day? Well, it's a whole cast of characters. And trust me, they have very, very different reasons for being there. So what's driving all this action? You might think it's giant corporations like Apple or Toyota moving money around for business. But that's only a tiny slice of the pie. The overwhelming vast majority of all that daily trading is pure speculation. Traders just betting on which way the price is going to move in the short term. First up, you have the hedgers. Think of a big multinational company, say a German car manufacturer that sells cars in the United States. Their goal isn't to gamble and make a profit on currency moves. No way. Their goal is to protect themselves from losing money if the exchange rate suddenly shifts against them. They're playing defense, really, using the market as a kind of insurance policy. And then you have the speculators. This group is the complete opposite. It's everyone from massive hedge funds down to individual traders working from home. They aren't trying to insure against risk, they are embracing risk. Their one and only goal is to profit from those price swings, and in the process, they're the ones who provide most of the liquidity that makes the whole market work for everyone else. And finally, you've got the real heavyweights, governments and central banks. Now, they aren't typically in the market to speculate. They're there to manage their country's foreign currency reserves, or in very rare and extreme situations, to actually step in and try to stabilize their own currency's value. You can think of them as the powerful referees of the game. So, with all of these different players pushing and pulling on the market, what are the actual big forces that make these currency seesaws tilt one way or the other? At its very core, currency movement often follows a pretty clear chain reaction. First, some big economic news drops, like a new jobs report or an inflation number. That news instantly changes what the market thinks the central bank is going to do with interest rates. And that one single factor, the outlook for interest rates, is probably the most powerful engine that drives a currency's value. Of course, it's not just about interest rates. Major political events, like an election or a geopolitical crisis, can send currencies on a wild ride. And so can the overall mood of the market, what traders call risk-on versus risk-off sentiment. When investors are feeling confident and bullish, they buy riskier currencies. When they get scared, they all flee to what they see as safe haven currencies. We've covered a ton of ground here, the incredible scale, the basic mechanics, the players, the drivers. So you might be wondering, how can you see all of this in action for yourself without having to risk a single penny? Well, the answer is something called a practice account or sometimes a demo account. Pretty much every online broker offers one. It's basically a complete simulation of the live market, but you get to trade with virtual money. It is the perfect way to get your feet wet and get a feel for how it all works. But, and this is a really big but, there is one thing you simply can't simulate. You can get the mechanics down, you can learn the charts, you can see the prices move perfectly, but the one thing you can't fake is the emotion of having your own hard-earned money on the line. That mix of fear and greed, that's a whole different experience. That being said, a practice account is an absolutely essential tool. It lets you trade in real live conditions without any of the fear. You can experiment with different strategies. You can see firsthand how markets react to a big news announcement in real time. And you can start to understand complex ideas like leverage and margin in a completely safe environment. So in the end, the Forex market is so much more than just a place to trade. It is the real-time, 24-hour-a-day pulse of the global economy, constantly reacting to everything from headlines to human emotion. The only question left is, what is it telling us right now?